I'm Michael Fox, and this is the Prospector podcast. And I have returning guest and good friend Chris Temple of the National Investor. Welcome, Chris.
Good morning.
Yes, it is. It's morning. We're going to see each other in a few days, but as we always do, the Fed made their announcements yesterday, so we're going to play armchair quarterback and talk about that.
Yeah. Well, uh, it was fun, and I said this a couple of different times before the meeting, Mike. I wanted to hear Jerome Powell's excuse this time for why inflation is going the wrong direction, but why he still insists they're going to hit their 2% target. And he didn't sound quite as stupid and deer in the headlights as Janet Yellen used to, and he wasn't quite as smooth in his obfuscations as Alan Greenspan famously was once upon a time, but he was still full of more shit than a Christmas goose. And we everybody and their dog and the fleas on a dog knows that there's no way in hell that the Fed is going to meet their 2% inflation target again sustainably unless we have a collapse in the markets and a major recession. And then we'll have lower inflation for a while until they inflate everything again. But barring that, inflation for several months has been rising. Don't forget that we were, I think, at the bottom back in the spring was 2.3% year over year PCE, and now we're at 3. And what happened, a week ago was that people on Wall Street were popping champagne corks that it only rose to 3 instead of 3.1. But however you cut it, it's going the wrong way. And the Fed is going to make it worse the more that they cut interest rates, which he hedged on, properly so during the conference yesterday. And, the bond market is calling his bluff again. So look, stagflation is here. It's entrenched. The only question is in which ways it's going to get worse. And, there's, as we all know, so many moving parts with policy, with geopolitics and everything else. But look, the Fed is in a messy position, as Powell himself has said. There's risk anything he does right now. There's no risk-free path that he could follow if he focuses on employment to the expense of inflation or vice versa. They're kind of screwed.
I wouldn't disagree. I quite frankly, I look at the overall economy as we kind of able to look at it. Their inflation, as you mentioned, is ticking up. There's been a whole raft of layoffs this year that aren't showing up in the unemployment numbers yet because of severance. They're going to start to take hold. Job creation is down, so labor markets don't look healthy. In spite of all of this, the stock market is inflated well out over its skis and is a bubble that wouldn't take a whole lot to burst. I'm looking at it. There is so many things that could go wrong here. It would take a miraculous effort on part of government and the Fed to navigate this without something breaking.
Well, that's true. I mean, I've said many a time, as you know, that even coming into this year and into his second uh, presidential term, that President Trump was facing some pretty bad math. We're already way overextended from the credit boom and orgy of debt that we had from late 2019 onward for a few years, which the Fed, let get way out of hand as a first matter, and then was late to start cleaning up. So that's already there. We've already got a substantially higher price level. If you look at just the average numbers, everything as far as living costs for the average American has risen by roughly a third in the last 4 or 5 years. And that's not going away. Now you're adding to that at a slower rate, but here again yesterday, and this was really condescending on Powell's part. He was asked during a press conference, why is it when he's thinking that things are so great inflation wise, why is it that consumer sentiment sucks? And why is it that consumers don't believe him on inflation? And their own long-term views of inflation are pretty pretty dour. I mean, he continually is pointing to these vague market expectations, and using this term that inflation is well contained. Well, it's not well contained on the part of two-thirds of the U.S. population who live paycheck to paycheck and don't see things as he does because that's what their checking account is telling them.
Yeah, well, you and I have discussed this ad nauseum, but there's a difference between the things that people need to have, a roof over their head, food on their table, health insurance, and the things that they might want, a brand new car, new clothing, a big screen TV. Those items seem to be holding and going down, but the things that they absolutely need, they're skyrocketing and skyrocketing, very quickly.
Well, they are, and nothing's really changed that. He also tried to dance around the inflation question by saying, well, if you remove the amount of the rebound in inflation it's due to tariffs, we're a lot closer to our 2% figure than it looks like, which is technically correct, I suppose, but it still obscures the big picture. And the big picture is that, number one, he was the proximate cause of all of the inflation since late 2019 in the first place. Number one. Number two, right now, this has been going on for a number of months, even apart from these renewed couple of rate cuts that we've had now, the last two Fed meetings. The balance sheet is going to stop shrinking imminently. They already are starting to inject money into the system through their various open market operations because there's been stress. You've had some subprime auto lenders go bust. It's starting to ripple into the regional banks. He claimed yesterday that he still doesn't see this blowing up into any system-wide problem yet, but in my opinion, that's inevitable again. For a lot of his hawkish talk yesterday, trying to pretend that he's still a little bit worried about inflation. It's the old saying, Mike, don't watch what I say, watch what I do. And the Fed's actions suggest that they know they're on the back foot, both in fighting inflation and in trying to keep debt service costs from going up faster than they are already.
Yeah, well, they've done a pretty good job of painting themselves into a corner in a lot of ways, but I do kind of feel a little bit sorry for them right now because, it's an organization that's data dependent. This data comes from the government, and we're coming up on a full month of the government being shut down, and I think next week we'll cross the Rubicon in it being the longest government shutdown in U.S. history. So he's kind of like a guy trying to decide what the weather's going to be like if the weatherman is off sick and there's no weather report. He steps out his door, licks his finger, sticks it in the air, and see which ways the wind blows.
Well, that's about it, I think, in some ways. And, he dutifully mentioned a couple of different times yesterday that they are kind of flying blind on data. They're doing the best they can, bear with us and et cetera. But yeah, this whole government shutdown thing is going to be making things worse imminently. And I don't mean just in a financial sense, but you're looking at a potential major social upheaval when you have, and I don't know what the number is because everybody argues over these different things, and half these people, I think, make up numbers depending on what their political bent is. But you're going to have a situation where 20, 30, 40 million, whatever the number is, of people who have become the most dependent on government handouts, food stamps, SNAP benefits, and things like that, they're not going to be able to eat. And they're not required in most cases to go out and try and find work. Not that that's easy for people, so I don't want to be, overly dismissive of that whole angle. But we got a problem, and and I think that politically in this country right now, things are so fraught. And I hate to see this as an American, that there are reasons why both the Republicans and the Democrats. The Democrats admitted it. The Republicans won't. But the Democrats, some of their legislative leaders, and I use the term leader loosely, whether they're Republican or Democrat, but some of the Democrat legislative leaders have basically said, we want the American people to feel pain to get our way. And they've got some legitimate gripes over the way that the whole healthcare thing and the subsidies and whatnot has been handled. But I mean, partly of their own making, because when the Democrats were in charge, they sunsetted the extra subsidies for people with low incomes that need health insurance. They're the ones that sunsetted it this year. Okay. But that aside, you've got an environment in this country right now where the Democrats really don't have many other arrows in their quiver but to cause social unrest. And I'm not looking forward to what a lot of major cities are going to look like come next week. And there's still no solution in sight for them to have their SNAP cards or EBT cards or whatever recharged. You've had a lot of people quoted on the news down here. They're just going to go into the grocery stores and help themselves. So you're going to have a lot of this kind of thing potentially. The Republicans, you have to wonder if President Trump wants that kind of thing so he can be even tougher in cracking down on crime and his version of domestic terrorism and stuff like that. So it's a very tenuous time beyond what this means for the Fed and the markets.
Yeah, but at the same time, you have to wonder when Marjorie Taylor Greene all of a sudden sounds like a voice of reason coming out of the Republican side, how
Right.
bad it actually is. Because she's going, maybe the Democrats have a point here.
Well,
You
she's
know,
absolutely right. And look, whether you agree with this or not, as a practical matter, the fact is that what is called open enrollment for health insurance in the US starts in a couple days. And everybody's got to have their ducks in a row as far as what your subsidy is going to be, what your resulting health insurance premium is going to be, and stuff like that. And the fact that as of the moment, there is no solution to this and that these extra subsidies are going to go away, you're going to see millions of people that depend on these subsidies for their health insurance have a massive increase in what their net premium is going to be. Now, it's back to what it originally was. All right. And this is all emblematic of the fact that our economy so favors the wealthy in this country, but not everybody else, that we've got ourselves in a position where more and more people are more and more dependent on the government, whether it's in this context for health insurance, the one I mentioned a minute ago for food stamps, and or both. So it's going to be a sudden change for a lot of people. And what Marjorie Taylor Greene correctly points out, along with the rest of her very, you know, factual take on this whole thing, I agree wholeheartedly with what she has said, is that don't forget that a lot of these low income rural people voted for Trump and the Republicans. And as do most voters, inevitably they're going to vote with their pocketbook. So this is not, you've got, and again, it depends on the eye of the beholder and whether you're hearing all of this on CNN or hearing it on Fox News. But a lot of people are going to rebel against the powers that be if things don't improve. And right or wrong, if this adds to the economic angst and pain that people are feeling, by the time you get to the midterm elections next year, she's not the only Republican who's warning that the Republicans could get their heads handed to them.
well, that is very much a possibility, and that's just talking about the government being shut down and some of the subsidies to the American people. That's not even crossing the other thing where you've got huge swaths of the government that, quite frankly, right now are working on IOUs. Yeah, you're working and we'll pay you someday.
Well, the president made a big deal out of one of his big supporters paying the paychecks 1 week for the military and stuff like that. But that, look, this can't go on forever. And I don't really know as we're sitting here who's going to blink first. Uh, the political calculus right now seems to be that next Tuesday in the U.S. is election day. You've got a mayoral election in New York City that's become a lightning rod. You've got governor elections in both Virginia and New Jersey, most notably. And both sides, I think, are betting that they're going to do well or better than expected, and that that's going to give them an upper hand. The interesting one is going to be Virginia, because a lot of the voters in the state of Virginia, of course, work for the federal government, and they're not getting paychecks. And the question is, who do they blame? If you believe some of the poll numbers, the Democrats are getting a bit more of the blame. And I think it's because the Republicans have had more reasoned, in relative terms, talking points, with the Democrats just shrill and angry and shouting about the whole thing, that they're not getting their way. And it's not that they don't have a legitimate beef over what, as a practical matter, needs to be done with these health insurance subsidies, but still, the optics are favoring the Republicans right now. So we'll see if that carries through. I listened to the Senate Majority Leader this morning, John Thune, being interviewed, and he was pretty much accepting of the fact that there's not going to be anything done until after everybody sees how these elections go next week. And then that might give one side or the other the added leverage needed to bring this to an end. But who knows? I mean, this is the state of politics right now in this country.
Yeah, neither side trusts the other to, basically do the right thing. And unfortunately, this is where you are.
Yeah.
Well, we've talked about the shutdown. President Trump was over in Asia getting, lots of gifts and praise from the Asian leaders. He announced the deal with China. I looked at it, it seemed to be a bit of a nothing burger, a bunch of vague promises and, pats on the head.
Well, look, I said a few weeks ago, in part in advocating that when they were near the recent peaks, we take some profits on some of the metals, and especially some of the critical metals and rare earths that have had huge runs, that there was a reason for both China and the U.S. to at least appear to stand down somewhat and have a ceasefire in what is still a long-term World War III over commodities and currencies. That big picture has not changed. This is a ceasefire, all right? And just as had been reported for the last few days, and just as, frankly, I predicted a few weeks ago, the biggest bones of contention between the two sides, you've got a little bit of give on it. Reportedly, China is going to back off of their more blanket embargo of rare earth element products for a year. In return for that, President Trump is not going to enact his added tariffs. He's going to sell higher falutin microchips to China. China's going to buy some soybeans, et cetera, et cetera. But again, these, in a broad scheme of things, don't change the big picture of the fact that the U.S. is still going to have to come up with a long-term industrial and economic strategy to replace these things from China, and the like. The other thing that has been conspicuous by its absence, in the initial reports at least, is there has been nothing said about China agreeing that it's going to stop buying Russian oil, because I guarantee you that behind the scenes, if President Trump even brought that up to President Xi, he was laughed at. So that's not going to happen any more than when the president recently claimed in a press conference that he got a promise from India that they're going to stop buying Russian oil. And his response was, well, that's news to us. So look, his belligerence in some of these regards is repeating a lot of the mistakes that Joe Biden made as president. And that is, when you've already got a trend underway where the rest of the world is trying to figure out how to go on with life, not fully dependent on the U.S. and not fully dependent on the U.S. dollar. And when the U.S. still has got some leverage to manage how that happens, you don't go out and say and do stupid things and push people away at a faster rate. And that's what Trump has done in the recent past. And it's going to end the same way, or it's going to lead to the same conclusion, is when Biden did it. And it's only going to hasten the day when when the world needs the U.S. no more, or a lot less than it does now.
Yeah, the thing with this China stuff though, Chris, is like I look at the rare earths and all I see is vague promises. And like all they've done with the rare earths is they've held back on what they were going to cut off further. But all those rare earths that were still kind of embargoed by the Chinese prior to April are still embargoed by the Chinese. Trump is cut the tariff rates a little bit, but they're still higher than what they were. I guess it's a small step back, but I'm really not seeing, as you say, a change to the bigger picture. And it still is, presenting challenges in the rare earth space.
Well, look, it's a subject for another discussion one of these days, but there really, at this point, isn't going to be, in any way, shape, or form, a change to the bigger picture. Okay. So long term, the U.S. still needs to have, as I've said before, a crash industrial emergency policy to replace all of these different things that we're still dependent on China and others for. All this does right now is it gives both sides a little bit of a time to catch their breath. You have a bit of a ceasefire. In the U.S., there's concern about rare earths and so forth. Professor Steve Hanke, who is very even-handed, he's not a Democrat or Republican. He calls him as I see him, like I do. And he said recently that, look, if China wants to, they can bring the West to its knees in 6 to 9 months. You've already heard from a lot of U.S. manufacturers and car makers. You've heard from the EU generally that they're really hurting from these rare earth embargoes, and so China's got us by the what when it comes to that. But China can only go so far because this has been the evolution of what I have called over the years the mutual assured destruction policy that the U.S. and China have had now for a long time. One side can threaten the other, but neither side can do completely without the other because their way of life, their economies, their supply chains, and their finances have become too dependent on what ended up being the biggest vendor financing scheme in all of recorded history between the U.S. and China. So I'm going to be talking about this separately in the near future, on my own platform to give people, take a couple steps back and look at how we got into this predicament in the first place, both the U.S. and China, frankly, Mike. But China's got its own problems and it can only go so far. I mean, they've got to use way more smoke and mirrors and baling wire and flim flam than even Jerome Powell does to keep their whole skyscraper of cards debt from completely imploding over there. They're way worse off in that regard than we are. So they can only go so far. So again, long term, the die is cast. And long term, you're still going to see a situation if our policy is pursued correctly in the US, and you're in the same boat in Canada, where the emergence of rare earths, base metal mining, all of the downstream parts of these industries, et cetera, will be built, rebuilt, whatever, in both the US and Canada. It's not being done at nearly fast enough of a pace, however, and it's at risk of being set back potentially by years if between the Trump administration and the Fed, they can't keep all the balls in the air where we're concerned either. And we have a very overdue retracement in the markets. I use a mild term rather than crash. And when that kind of thing happens, everything is set back for years. Capital isn't going to come into the markets, including for metals or anything. So we still have the same need that we did before. But, when I told our members a few weeks ago to take some of the money off the table that we've made even from precious metal stocks, because this correction is likely to go on as well, let alone from the rare earths and some of those related things like that. It's not because my long-term pictures changed. It was because it was clear to me that we were going to have at least this stated deal. And a lot of the hot money that came into the rare earths and related stuff, especially in the recent past, was going to leave, at least for a while. It'll come back, but not tomorrow or next week.
No, and I was going to ask you about the commodities because, they had gone up at a rocket's rate, a lot of them. And the sake of copper, platinum, and palladium, they were at, highs that kind of fly against what we see in the general economy. Um, Now they seem to be all correcting. And you're right. We are overdue for a market correction in the stock markets. And that will cause some problems. But even then, we still don't have the investment in the commodity sector that's needed to drive what is needed for the bigger picture of, strategic needs for a lot of these metals and commodities. So if this happens, is there going to be more government investment like we've seen with MP Metals and with Lithium's Americas and with some of the other people that Trump is starting to turn the government coffer into a hedge fund.
Well, look, some of the stuff that the president has done has been very insightful, even if it's of dubious legality and constitutionality. That the Fed, or that the federal government has the authority to take stock and pick winners and losers as a result, of course, in private companies, even if it is an economic need, national security need. That's a whole different subject. But the big picture, I have been yapping my gums for a long time about the need for things like a national infrastructure bank that would not be dependent on the federal budget. Because my fear is this, very bluntly, and I alluded to it a minute ago, Mike, if we have an overdue major correction in the stock market and this daisy chain of these real and imagined AI investments and stuff where one company announces an investment, that company announces an investment in somebody else, then that somebody else announces an investment back to company number one. And this has been the basis of trillions of dollars of added market cap, and it's all bullshit. Okay, when does that catch up with the broad market? I'm not saying AI is not legit in some ways, but it's been vastly overhyped, and it's been overhyped because for all of its lack of a depth of knowledge in so many areas, at least the Trump administration does seem to get the macro picture right now, and they realize that if they don't come up with all of these ways to at least pretend that there's all of this new wealth creation and so forth, and everything implodes and it works anymore. Then all of a sudden, instead of going to a South Korea and getting a replica of a gold king's crown, he's going to come back to the U.S. and get a dunce cap. If these bubbles collapse, because then he can't do anything, including put more money into more different projects. So, again, as I said before he took office, and I alluded to this a couple minutes ago too, the math is very much against him, and he's going to have to do stuff way beyond what he's talked about and actually done to this point to not only stave off some kind of a collapse down the road, but to make sure that he's got the ability to put into place the kind of industrial policy and America First middles policy, which we do indeed need. But in these respects, I have to say that when you look at the big picture of what actually has to be done to get us off of dependence on China for rare earths and copper processing and so many other things, to get us off of dependence on Russia and Kazakhstan for enriched uranium or whatever. I mean, he's brought a water pistol to a gunfight, and it's just not nearly enough. And so far, aside from these one-off investments and stuff, and again, I'm not denigrating any of them for the most part, but it's not nearly enough, and it needs to be brought about with a much more long-term industrial policy rather than throwing a bone here and there to a certain project.
Yeah, it's like most of the things I see in government, and it's not just a US Canadian problem. They seem to make these unconnected announcements and investments and things without an eye on the bigger picture in a lot of cases. And I use this as an example. Okay, they're investing in mines, but there's no processing of the minerals. They're investing in a processing plant, but is there going to be stock to be able to go into that processing plant? They need all of this here. Are they training the workforce to be able to take the jobs that they're going to create if they do all of this? And there seems to be major disconnects all the way up and down that supply chain that looks like they're putting a band-aid on an aneurysm.
Well, and that's a great point. Yesterday I recorded a podcast with a guy that we met in the Twin Cities at the Better in Our Backyard conference. His audience is primarily people in the energy industry. And, the point I made to him very simply, Mike, and it can be made this simply, is, the Trump administration, the way it's going about so many things, is really indistinguishable from what Biden did. Biden has an end goal. I want electric vehicles. I want windmills. I want carbon reduction. Okay. But without anything close to the full menu of policy changes, economic investment, engineering things, industrial policy, game plan, everything. It's like, I want, and you mandate some things, but the components just aren't there to make it happen. And President Trump, I'll say, has done a better job by far on putting some meat on the bones, especially when it comes to nuclear energy and some of this. But generally speaking, it's still, to me, kind of like what Biden did. He's got this energy dominance council. Huzzah! That's wonderful. Well, what do? He wants to have drill baby drill. Well, guess what? Just like you finally came to your senses and realized with the MP Materials deal that you need to guarantee an economic price for the end product, and that was a phenomenal thing. You and I have talked about that. Well, maybe you have to consider what needs to be done for the energy industry to make sure that this rolling over of U.S. oil production that's already underway doesn't accelerate. And if you want that, you're going to have to understand that the oil price can't be where it is. It's going to have to be higher. And so now he's really in a mess because he wants to brag about bringing gasoline costs down, and he wants to brag about inflation being down, which is not. Of course, that's one of the many factoids that he just pulls out of his nether region and with no substantiation. But I want to hear him sensibly address this. Are you prepared for oil to be $89 or $90 a barrel in order to keep U.S. production where it's at, if not go higher? Instead of looking at the domestic economic things, he's trying to pick a fight, and have some pretense to invade Venezuela. Guess why? They got a lot of oil.
Yeah, that's all very true. Let's take a look at the precious metals and the bond markets. They're also, they're flashing red lights and sirens that something ain't right here.
Well, they have been in a way. And look, the fundamentals undergirding this spike, which was unsustainable, even if it's got more behind it than we've seen in the past, they're undeniable. The world has changed. I'm going to be talking about this in the near future as well, also to kind of go into all of the reasons why, despite the fact that we are going to have a rolling correction now for gold, the world has changed. And ultimately, we're going to go a lot higher in the price. But near term, simply put, I'll give you two technical things, Mike. Number one is, and Jeffrey Gundlach alluded to this yesterday in his own post-Fed interview on CNBC. He follows Market Vein, which may be a name familiar to some folks out there. They're a very technical-oriented service that follows investor sentiment and stuff like that. And at its recent peak, nearing $4,400 US an ounce, gold's bullish sentiment of 95% was historically higher than it's ever been since those records were kept. Everybody that was going to buy had already bought. And when you see a chart, and I warned people of this, a few weeks ago when we were getting up there, I still love gold long term. Don't misunderstand at all. But any chart, I don't care what it is, that goes parabolic like that is going to pull back. That's never sustainable, and it's not sustainable here. So, as I'll be sharing with our folks in a couple different ways in the coming few days, my downside targets for the gold price are, as a first matter, $3,600 to $3,800, and as a second matter, this is probably the worst case scenario, $3,300 to $3,400. And I'll have the chart points to explain why. What I had our folks doing was taking some money off the table with a few of the larger names that have had bigger runs, as well as we probably cut in about half our ETF exposure to the gold and silver stocks via the ETFs. But at the same time, I've told people that what you also need to be doing right now is redeploying some of that money down the food chain to some of the better exploration stories. I've interviewed several of them again recently. They're on my YouTube channel of stocks. Some of them have had nice moves. Some of them had more modest moves. But right now is when you want to be, backing and filling and reloading on some of the, lesser known names and lesser picked over names that have got really good stories. So I'm still very constructive long term on gold, but near term, this is going to be a rolling correction that probably is going to resemble the last one we had. If you go back, for example, to the, 2020-ish time frame, with the Fed starting to print money with COVID. We popped above 2000, fluttered around for a while, popped back above 2000, went back down to around 1600 or thereabouts. But, you never had more than, maybe a 20% top to bottom decline. It was more of a rolling correction before we had this last huge run this year. I don't think we're going to see anything worse than that.
Yeah, we were way out over our skis, like even in the wildest of projections to when we were going to get to $4,000. Nobody had it happening this year. It was all, a lot of cases, it was all third quarter 2026 that they were projecting it. And it took off like a scalded cat. And, as you say, it can't run that fast without tiring out and correcting back down. And I think that's exactly what we're seeing right now. And
But
I think,
the long term story is still intact, and frankly, this correction is going to be a gift to people with sense enough to know how to load up correctly.
yeah, well, you buy stuff when it's on sale, right? You don't, no,
Right.
nobody pays retail.
Right.
The bond vigilantes, are they rearing their heads? There's been a lot of reason for them to do so. The government shut down, the Fed really not having data which to make their decisions, the regional banks, which we discussed. What's happening with the long-term bond issues?
Well, long-term bonds yields are still going to work against the Fed and the Trump administration both, and I think that's a good thing to remind people as we close because this is going to affect everything, not only the precious metals, because the metals are going to net get hurt more if long-term interest rates rise a bit more. And as the dollar continues to rise, the dollar has been bottoming under everybody's nose and is about to spike higher itself. That's not going to help the metals either, all else being equal. But, Gunlock made a great point yesterday in his comments. If you go back to last year, before the Fed started its first round of interest rate cuts, if you look at the 2-year Treasury yield before the Fed started cutting in September of last year, the 2-year yield is a bit higher right now, or it's about the same. I take that back, about the same as it is today. And that was because back then the market had gotten out in front of the Fed, was trying to pull the federal funds rate down. The 10-year Treasury is a bit higher right now than it was when the Fed started cutting rates last year. So the Fed has cut 150 basis points off the federal funds rate, and yet the 10-year Treasury compared to what it was at right before the Fed started is a bit higher than it was then. And that tells you a lot of things. It's about the sheer volume of financing that the Fed or that the federal government needs going forward. It's about the volume of paper that's already out there. It's about inflation expectations still being much more substantial than Powell wants to admit, et cetera. So I'm one who still believes that interest rates are going to stay chronically high along with inflation. And both of those things still have not, in my view, been fully reckoned with by the markets, especially by the stock market. But it's still, I think, inevitable. We keep saying that, but it's still going to come home.
Yeah, the chickens eventually do come home to roost. Folks, if you're going to be in the New Orleans area next week, November the 2nd, 3rd, 4th, Chris and I will be at the New Orleans Investment Conference. You should stop by, introduce yourselves, and have a conversation with us.
Absolutely.
Chris?
I look forward to seeing you, Mike.
And Chris, if people want to follow your musings further, how would they do so?
Just go to nationalinvestor.com and follow the yellow brick road. You can sign up for free commentaries. Our paid membership discount ends when we turn the clocks back here this weekend. We're also going back to full price instead of half price, so don't delay. If you're interested in getting all of my recommendations, you can get that there at nationalinvestor.com as well.
Perfect. I look forward to seeing you next week, Chris, and
sure.
safe travels down there. And that conference is always a good time.
Take care.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.